So,
Very good morning, friends. We are going to take up the next session of MMPF002 on the title Capital Investment and Financing Decision. I'm your resource person, ASEEM Kumar. Last week, due to certain other technical glitches, we couldn't just convene this particular session. So, we are just taking it up today for your perusal and understanding. Friends, up to 20th of August, we have covered Block 1 on the title Financial Decisions and Overview. Under this particular block, we have covered Unit number 1, Nature of Long-Term Financial Decisions, Unit 2, Cost of Capital, Unit 3, Capital Structure Decisions. We have covered Block 2 as well. In Block 2, we have taken up the subject of investment decision under certainty. And then we have covered Unit 4 for project planning and formulation, Unit 5 investment appraisal, evaluation criteria, and then under Unit 6 we have completed project implementation and control, and finally we have covered Unit 7, which was based on social cost benefit analysis, SCBA. Because we could not convene this particular session, therefore the coverage on 27th August we couldn't just complete it, and today we are just going to take it up this particular session of Block 3, investment decisions under uncertainty. Investment decisions under uncertainty. We are going to cover investment decisions, risk and uncertainty, and Unit 9, project evaluation under risk and uncertainty. Friends, let us just look at the unit number 8 first. Investment decision, risk and uncertainty. Risk and uncertainty, because as such the risk is always uncertain. You are just going to take up a sort of estimated thing, and you have to make a sort of foolproof plan, a sound plan, so that at least you can just cover it up properly and then just take up your risks and other uncertainties well. So basically, long before the development of capital asset pricing theory number 1, which says that the equilibrium rates of return on all risky assets are a function of their covariance with the market portfolio. See, covariance with the market portfolio. Smart financial managers adjusted for risk in capital budgeting. Okay. The smart financial managers, they adjust for risk in capital budgeting. They always just keep this particular realization and they keep a sort of cushion in that. They realize intuitively that if other things being equal, risky projects are less desirable than safe ones. You are normally just talking about the safe zones and safe projects all the time. Therefore, they demanded a higher rate of return from risky projects. Once you are just doing the business, definitely you are just always thinking for that, why me? Why the risk is to be covered by me alone? So when you are taking the risk, you are definitely asking for a higher rate of return from the risky projects, or they based their decision on conservative estimates of the cash flow. Because when it is risky, definitely you have to have the conservative estimate of the cash flow, because otherwise the risk and the uncertainty would be just clubbing together, and then it will be just coming out to be a sort of dislocation sometime for people. So the conservative, say, estimates of the cash flow, you have to just take it up. See, there are various rules of thumb are often used to make these risk adjustments. For example, many companies estimate their rate of return required by investors in its securities and use this required rate of return to discount the cash flow on all the new projects. See, initially only they just take out the risk adjustment. All right. Since investors require a high rate of return from a very risk company, such a firm will have a higher company cost of capital and will set a higher discount rate for its new investment opportunity. So all the way, everyone is just coming up because anyone who is just investing in the risky project, definitely they'll be asking for a higher rate of return as well. So very risk of the company is being distributed at different level. So cost of capital will be higher and the higher discount rate also for the investment opportunities. Few seconds. Yeah, capital asset pricing model, CAPM, it is called in abbreviation. CAPM approach is used to estimate risk adjusted discount rate for making investment decisions. It is a theory about how the prices of risk financial assets, securities are determined in the capital market. Friends, capital asset pricing theory tells us to invest in any project offering a rate of, say, rate of return that more than compensate for the project's beta. Now, what is that? This means that ABC should have accepted any project above the upward sloping market line. The notion that each company has some individual discount rate or cost of capital is widespread, but far from universal. So many firms require different rate of return from different category of investment, but natural. Because see, quote unquote, you are just having different investments, different activities, different risks, different discounts, and their purposes as well. So discount rates might be set for different investment purposes, as I said. In brief, the main insight of CAPM are investment. The investors need to be rewarded for systematic risk only because unsystematic risk can be reduced to zero through diversification of investment portfolio. See, you can just unsystematic risk can be reduced only because you are diversifying the investment portfolio. A security's systematic risk is measured by beta value. The required rate of return on a security depends on riskless rate of interest, the market risk premium, and the security's beta value. So now, how to measure betas and capital assets? Now the question arises how to use beta pricing model to help cope with the risk in capital budgeting situation. The main problem in how to estimate the discount rate. The formula is rate is equal to RF plus beta P in bracket RM minus RF, where R is discounting rate and then it is RF is risk-free rate, RM is market rate of return, and then BP is project beta. If you are just putting up a data, the particular mathematically we'll be able to just get it. The discount rate, discounting rate, how much we have to just give it for this particular calculation of beta. Okay. In addition, in order to do that, you have to figure out the project beta. It is a difficult problem so much so that many people hope that it will go away if they ignore it. See, ultimately they may go away, but unfortunately the problem won't. It will pass, but the problem will remain. Any investment decision that is made contains an implicit assumption about the project risk. We'll start by reconsidering the problems you would encounter in using beta to estimate a company's cost of capital. It turns out that beta is difficult to measure accurately for an individual firm. Much greater accuracy can be achieved by looking at an average of similar companies. Then we have to define that the similar, among other things, we'll find that the firm's borrowing policy affect its stocks beta. It would be incorrect, for example, to average the beta of a company which has borrowed heavily and the one which has not, although they may have similarity otherwise. The company's cost of capital is the correct discount rate for projects that have the same risk as the company's existing business, but not for those that are safer or riskier than company's average. The problem is to judge the relative risk of the project available to the firm. The problem is to judge the relative risk of projects available to the firm. And that is, of course, the essential part of your business policies and strategies. Stability of betas over time. Of course, evidence from two carefully selected stocks is not worth much, but betas appear to be reasonably stable. Sharpe and Cooper provided an extensive study of stability 3. They divided stocks into 10 classes according to the estimated beta in that period. Each class contained 1/10 of the stocks in the sample. The stocks with the lowest betas went into class 1. Class 2 contained stocks with slightly higher betas and so on. The lowest, slightly higher, and then the things will just go on the higher side. They then looked up at the frequency with which the stock jumped from one class to another. The more jumps, the less stability. Okay? The stock jumps from one class to other. If there are more jumps becoming like the lowest beta and then it becomes the higher one and then so on. If it is just frequency is higher, that means less stability. But if the frequency is less, definitely you have the stability of the stocks. Asset betas and equity betas. Two different mode we have. We have the corresponding thing in the balance sheet. Think again of what the company cost of capital is and what it is used for. Okay, we define it as the opportunity cost of capital for the firm existing asset. All right, we use it to value the new assets which have the same risk as the old one. The right beta for calculating the company cost of capital is the beta of the firm's existing assets is asset beta. Note that the value of debts and equity add up to the firm value. D plus E is equal to E, and that the firm value equals asset value. The firm value equals the asset value. Stockholders own the firm's equity, but they cannot claim all of the asset value precisely as per rules and as per policy. They have to share it with the debt holders because they have the priority in case of liquidation. The debt holders receive part of the cash flows generated by the firm assets and they may bear part of assets risks. Because they have the priority, they will be receiving, the debt will be receiving the interest first out of the cash flow being generated by the firm. Therefore, they have to bear and they may be part of the assets risk also. Sometimes, not always. Business and financial risk. A firm asset beta reflect its business risk. Alright, the fluctuation and other things. The difference between the equity and asset beta reflects financial risk. More debt means more financial risk, but natural. You have your own funds, definitely you have a peace of mind because you will be just giving them profit only if the profit, the institution is in plus. Their dividend would be subject to the profits, but if not, definitely their dividend would be kept in abeyance. But if it is a debt, you can't do that. Even if you are incurring losses, you are supposed to pay the interest. So more debt means more financial risk. What would happen if the company decided to use more debt and correspondingly less equity? It would not affect the firm's business risk. There would be no change in the firm's asset beta and no change in the beta of portfolio of the entire firm's debt and equity security. Okay? But the equity beta would change, however. The equity beta would change, however, because whatever the status you have just arrived at, it would not be having any change, because in any case the effect would be say same. Whatever effect you were just finding out, the effect would be same. And what determines the asset betas? Stock or industry betas provide a rough guide to the risk typically encountered in various lines of business. However, an asset beta for, say, the steel industry can take us only so far. Not all investment made in the steel industry are typical. What other kind of evidence about the business risk might a financial manager examine? See, in some cases, the asset is publicly traded. If so, we can simply estimate its beta from the past price data. For example, suppose a firm wants to analyze the risk of holding a large inventory of copper. Holding a large inventory of copper. Because copper is a standardized, widely traded commodity, it is possible to calculate rate of return from holding copper and to calculate a copper data. All right. But what should we do if our asset has no such convenient price record? Then the advice is to search for the characteristics of the asset that are associated with the high or low betas. We wish that we had a more fundamental scientific understanding of what these characteristics are. We see business risks surfacing in capital market, but as yet there is no completely satisfactory theory describing how those risks are generated. Nevertheless, some things are known. Cyclicality, many people intuitively associate risk with the variability of book or accounting earning. However, much of this variability reflects diversifiable or unique risk. Loan prospectors in search of gold look forward to extremely uncertain future earnings, but whether or not they strike it rich is unlikely to depend on the performance of the market portfolio. Even if they do find gold, they do not bear much market risk. Therefore, an investment in gold has a high standard deviation, but a relatively low beta. Operating leverage. We have already seen that financial leverage, in other words, the commitment to fixed debt charges, increases the beta of an investor's portfolio. Investor's portfolio, that is, increases. In just the same way, operating leverage, in other words, the commitment to fixed production charges must add to the beta of a capital project. Let us see how this works. The cash flows generated by any productive asset can be broken down into revenue, fixed cost, and variable cost. So, how it comes out to be? Cash flow is equal to revenue minus fixed cost minus variable cost. Okay? Friends, costs are variable if they depend on the rate of output. Okay. Examples are raw material, sales commission, and some labor and maintenance cost. These are variables, the rate of output, how much production you are just planning to. If the production is higher, definitely the variable cost would also be higher. But on the contrary, the fixed costs are cash flows that occur regardless of whether the asset is active or idle. So suppose you are not using the building, you have to pay the property tax. For example, or the wages of worker under contract. You have deployed some workers. If you don't have work, if you don't have order to say convene, definitely the contractual workers will be there with you, at least the minimum part. So you cannot just avoid those costs. That is why the fixed cost occurs regardless of whether the asset is active or idle. Okay, we can break down the asset's present value in the same way. PV asset is equal to PV revenue minus PV fixed cost minus PV variable cost, or equivalently. See, the revenue is always having some fixed cost coverage and prominently of variable cost coverage. If it is covering the fixed cost also in full, gone to the break-even point. And if the revenue is more than that, that is the margin of safety. And if we just look at PV revenue is equal to, like we are just taking this particular example and then it is just giving you, if suppose we look at the PV revenue, it is PV fixed cost plus variable cost plus PV asset. Okay, the PV asset. Those who receive the fixed cost are like debt holders in the project. Those who receive the net cash flows from the asset are like holders of the levered equity in the PV revenue. Okay. Now searching for the clues. Recent research suggests a variety of other factors that affect an asset's beta. But going through a long list of these possible determinants would take us too far afield. Friends, you cannot expect to estimate the relative risk of assets with any precision, but good manager examine any project from a variety of angles. Like quote unquote, you are not thinking from one angle alone, you are thinking from the other angle as well. And then look for the clues as to its riskiness. Then what do they do? They know that higher market risk is the characteristics of cyclical ventures and of projects with high fixed cost. So what they do? They think about the major uncertainties affecting the economy and consider how projects are affected by these uncertainties and they plan it accordingly. All right. Friends, with that, we have completed unit number 8 and now we are just moving on to unit number 9, project evaluation under risk and uncertainty. Concept of certainty, risk and uncertainty. Let us just say, look afresh. What is the certainty? Yes, I could say it can happen. If it is a risk, it may not happen. Uncertainty, it may not likely to happen. So 3 stages there are. Let us just look at what our bigger thinkers they say. Certainty is a state of nature which arises when outcomes in terms of cash flows are known and determinate. you are knowing about. For example, if one invests 20,000 in 5-yearly government bonds, which is expected to yield 7% tax-free returns, then the return on investment at the rate of 7% can be estimated quite precisely. Thus, the outcome is known to have a probability of 1. Now, next. Risk involves situation in which the probabilities of cash flows occurring are known, and these probabilities are objectively or subjectively determinable. See, in the risk you have the situation and the probable things. You can just think of this objectively and subjectively, and you can determine it. The main attribute of risk situation is that when the event is repetitive in nature and possesses a frequency distribution, it is the inability of the to predict with perfect knowledge the course of future events that introduces risk. Okay? The main attribute of risk situation is that the event is repetitive in nature and possesses a frequency distribution, different distribution. So now you have a sort of prediction inability. You cannot just predict with perfect knowledge what would be the course of action that introduces risk for the project. So all the three we have understood now: certainty, risk, and uncertainty. In contrast, when an event is not repetitive and unique in character, and the finance manager is not sure about the probability of cash flow themselves, uncertainty is said to prevail because it is not repetitive, unique, maybe for the first time, second time. The finance manager also is just coming out about the probabilities in cash flows themselves. Then it is absolutely uncertain. Earlier we were just thinking about the risk part. So uncertainty is subjective phenomena. In such a situation, no observation can be drawn from frequency distribution. Practically no generally accepted methods could so far be evolved to deal with the situation of uncertainty. While there are a number of techniques to deal with risk, as such, the term risk and uncertainty will be used interchangeably. See, sometimes the risk is also uncertain. So, what you do, you try to understand the basics of it, the crux of it, and then you wait. All those values and techniques, all those matters which will be coming up. So with that, the risk part, the certain part, then the risk part, and the more risk part we have understood. Measuring the risk of a project. Now, the techniques we were just thinking about. Since prime objective of a finance manager is to maximize the value of the firm and the degree of risk in a project affects the value, he must measure this degree of risk in different projects under consideration. How? The probability distribution. Of course, when the things are uncertain, you are always thinking in probable part. So the probability distribution, the problem of project risk. As noted above, the riskiness of an investment project is the variability of its cash flows from those that are expected. The greater the variability, the riskier the project is said to be. The variable part, if it is more, then definitely the riskier the project is said to be. For each project under consideration, we can make estimate of the future cash flows rather than estimate only the most likely cash flows outcome for each year in the future. We estimate a number of possible outcomes. In this way, we are able to consider the range of possible cash flows for a particular future period rather than just the most likely cash flow. See, the probable part, you are now, your mindset is prepared. You are just having the probable outcomes and probable strategies in your way. And therefore, you have more options to take care of the uncertainty. The total project risk is what? If investors and creditors are risk averse, and all available evidence suggests that they are, it is necessary for management to incorporate the risk of an investment proposal into its analysis of the proposal's worth. When you are giving a proposal, you have to just keep that also in mind. Otherwise, capital budgeting decisions are unlikely to be in accordance with the objective of maximizing share price. Having established the need for taking risk into account, we proceed to measure it for individual investment proposal. But remember that the riskiness of a stream of cash flow for a project can and often does change the length of time in the future that the flows occur. In other words, the probability distributions are not necessarily the same from one period to the next, because time changes, the circumstances changes, the policy changes, then the equation changes. So the probability distribution may, but we have to think about the may not also, not necessarily the same from one period to the next. Sensitivity analysis. When we are looking at the sensitivity analysis, intuitively we know that most of the variables which determine a project cash flows are based on some type of probability distribution. Okay? Know that if a key input variable such as units sold changes, so will the project's NPV, net present value. Net present value. Sensitivity analysis therefore indicates exactly how much NPV will change in response to a given change. Now we have just discussed about the probability distribution. So in a given change, what NPV will change in response in an output variable, other things remaining constant. We always think like economics that other things will remain constant. Sometimes called what if analysis, sensitivity analysis answer questions such as these. What if sales are only 20,000 units rather than 25,000 units? What then will happen to NPV? In a sensitivity analysis, we change each variable by specific percentages above and below the base case value, calculate new NPVs, obviously, holding other things constant. This is again the thumb rule. And then plot the derived NPVs against the variables in question. Our next analysis is scenario analysis. A risk analysis technique which reconsiders or considers both the sensitivity when they are just looking at both the sensitivity of NPV to changes in key variables and also the range of likely variable values is scenario analysis, is a scenario analysis. Here the operating executive pick a bad set of circumstances: low unit sales, low sales price, high variable cost per unit, high construction cost, and so on, and a good set correspondingly. The NPV under the bad and good conditions would be calculated and compared to the expected or base case NPV. There is another Monte Carlo simulation which gives us the other idea. The Monte Carlo simulation, so named because this type of analysis grew out of work on the mathematics of casino gambling, ties together sensitivities and input variable probability distribution. However, simulation requires a relatively sophisticated computer coupled with an efficient financial planning software package, while scenario analysis can be done using a handheld computer. Okay? Decision tree analysis. Friends, many capital budgeting decisions are not made at a single point in time. It may be gradual, it may be sequential, it may be step by step. Okay? Rather, they consist of two or more sequential decisions which are made as the project progresses through stages. This gives us a sort of idea that, okay, our cautious movement does not stop at any moment, at any time, at any period. So we go along with the policies and the strategies as the progress of the project goes along. There is another, thought process is game theory. Since game theory can be used as a technique for dealing with cases of complete ignorance of the initial probabilities of possible outcomes, the reader might be inclined to pitch his hopes for useful guidance a little higher. Once you are not in know of it, the probabilities, definitely you'll be needing the guidance as well. Again, he is likely to be disappointed, likely to be sometime. But before pronouncing judgment, we shall illustrate with one or two simple examples the relevant techniques known as the two-person zero-sum game, so called for the rather obvious reason: one, that the game is played between two persons or groups, one of which may be nature, and two, that there are no mutual gains to be made, the gains to one party being exactly equal to the losses suffered by the other party. See, this is something, a game theory. It will never be that it will be a mutually gain, it will be just coming up. Whatever you are gaining, it would be the loss of somebody else. So this, what about the game theory says? And in practical, you will be just finding out the same. The expected utility approach. The expected utility approach. Here we will develop a model of consumption, investment decision by individual under condition of uncertainty. The general problem can be described as follows. Consider an individual who must take a consumption minus investment decision at each of R discrete points. Okay? R discrete points in his lifetime. At the first decision point, he has a quantity of wealth, W1, that represents the maximum possible level of consumption during time period 1. At the beginning of period 1, the W1 must be split between the current consumption C1 and the investment. Okay, the W1 and minus C1 is equal to H1. Okay, the H1. At the beginning of period 2, the individual wealth 2 is H1 1 plus R2. 1 plus R2. R2 is the percentage expected rate of return in period 2. R2 is a random variable, therefore W2 is also a random variable. Friends, understand uncertainty. The decision problem is of course complicated by the fact that the actual lifetime consumption sequence is to some extent unpredictable, because as indicated above, the wealth levels produced through time by any given investment strategy are usually random variables. Thus, in order to solve the individual's sequential consumption minus investment problem, we need a theory of choice under uncertainty that defines the criteria that the individual uses in choosing among different probability distribution of lifetime consumption. The theory of choice, therefore, we have to just look at the expected utility model. The expected utility model. What it says, the theory of choice under uncertainty that we apply to the consumption investment problem is the expected utility hypothesis. In general terms, the expected utility hypothesis states that when faced with a set of mutually exclusive actions, each involving its own probability distributions of outcomes, the individual behaves as if he attaches numbers called purely for convenience utility to each outcome and then chooses that action whose associated probability distribution of outcomes provides maximum expected utility. In the R period consumption minus investment problem, an outcome is complete sequence of lifetime consumption. CR is equal to C1, C2 and to the level of CR, the next period or any level we are just intending to achieve. And an action is a R period consumption minus investment strategy that produces a probability distribution for different possible lifetime consumption sequences. But because the consumption investment problem is just one possible application of the expected utility model, first see the model in its most general form, since we are confronted here with how the individual ranks outcomes and probability distribution of outcomes just as behavior in conformity with the ordinary utility model. So we have 5 axioms that can help produce a better understanding of the model. Friends, with that we understood that if suppose we have to just look at the risk part, whether we have to just talk about the uncertainty part, first we have to assess where we are. And then we have to just take out the connected parameters. Once we are reaching to the connected parameters, then according to the risk probability we have, we are just putting those data in the different formulas according to the situation, according to the data we have, according to the circumstances we are going to predict. So with all those, we just come down to reducing the risk or interchangeably the uncertainty part as well. Because plans, the plan part is always expected from the business tycoons. If it is just coming out to be okay, then only one can just go ahead with the increase in their firm price, increase in their share price, increase in the value of their own. And if the increase in value comes out to be, it is the growth of the organization, growth of the institute, growth of the firm. And that is why you have to just come out with all those models interchangeably as and when things are coming up, and can achieve your utmost profit or the desired profit out of the riskier project as well with flying colors. Friends, with that we have completed unit number 9 and block 3 as well. In the next session, we are going to take up the next block, that is block 4, and the corresponding units as well. Thank you so much for today, for listening so carefully and understanding the concept of the projects under uncertainty. Thank you once again. Namaskar.